Quite pertinent point you made, Anuj, is conserve and grow, and pass it from one generation to another. Managing wealth also means conserving before growing, or is it one after the other? How does it work?
Wealth means different things to different people. Human behavior and hence investor behavior could be very, very different. I think so long as you're clear about your principles and your objectives and you consistently apply them over cycles, that's perhaps an easy way or a simple way to define how you should be looking at preserving and growing your wealth.
If I were to move from A to B with my wealth manager moving, right, why would I want to choose relationship over returns?
You wouldn't. And which is why 70% of the assets will not move.
Can my risk perception change, and how does the risk mapping happen?
Such a volatile world.
Absolutely.
Today a COVID happens or a war happens or interest rates change. Constantly evolving mindset of our investors.
Okay.
And keeping pace with that evolving mindset to make sure that we are customizing our offerings based on their evolving mindset.
Hello all and welcome to the next episode of Bold by BlinkX. And today we have a special guest, Anuj Kapoor, who is the Chief of Wealth Management in JM. Thank you so much, Anuj, for taking time to be part of Bold by BlinkX. Thank you.
Thank you for having me here. It's a pleasure.
Thank you. So Anuj, wealth management, private wealth is the in thing now. Everybody talks about it. Every financial services intermediary talks about it. And हाल ही में मैं आपका interview भी पढ़ा था. So I thought it might be a good idea for me to have this small conversation with you on wealth. For our audience here, what does private wealth mean?
I think just to put it very simply, it's just a tool or a mechanism to preserve and grow your wealth in a methodical fashion. We get so consumed in our daily lives, be it our profession or our families, that we rarely find time to look at what we have earned and what it has earned. So just putting it in a framework where we can start looking at what we have made and how we can preserve and grow that and generationally pass that on and what we want to do with that. That's the framework with which private wealth looks to address. And that's the job of a private banker.
Quite pertinent point you made, Anuj, is conserve and grow, and pass it from one generation to another. So I'm just pausing on that particular question. So managing wealth also means conserving before growing, or is it one after the other? How does it work?
It's simultaneous.
Okay.
Wealth means different things to different people.
True.
For some, it may mean holidays. For some, it may mean inheritance for their children.
Yeah.
And for some, it may mean a lifestyle. So very often, the perspectives or the objectives with which people want to look at wealth are different.
Okay.
A family would or could look to just conserve its principle and look at just beating inflation,
Okay.
and hence be very, very conservative. Whereas the objective of a different investor could be very different and he may be very aggressive and hence look at growth in a very, very different fashion.
Wow. So is it a function of the age of the investor or the background of the investor? So if I'm a first generation wealth creator, would I view the private wealth management in a different fashion than maybe a second generation or a third generation? How does it?
Yeah, tough to categorize it in that fashion.
Okay.
There may be some generalizations to draw, as you rightly put, but it's to do with a lot of factors: your background, your education,
Okay.
your profession, the social circle that you keep, a lot of these factors, and what you expect from life, what your objectives from life are. So a lot of these factors impact what you look to do with your wealth. And yes, on a generalization basis, it would be fair to say that today, clearly the younger generation, the Gen Z, the Gen X, they're looking to grow their wealth
Okay.
a lot more aggressively, and hence the tilt towards equities being a thematic as well.
Wow, wow. But if I look at some data points here, we have 20 odd crore demat accounts. So it basically says that there is higher participation in equity. In this media noise, how do you define a real wealth client's behavior? This is how a real wealth client looks like, something like that?
Again, there are categories. I would stratify the market, generally speaking, into uh, the mass affluent,
Okay,
the HNI, the ultra HNI,
okay.
and the family office market. And there's no clear cut sort of guideline.
Oh,
Very, very loosely sort of framed uh, quantums of wealth that or disposable wealth, investable wealth that one could look at in terms of categorizing in these. And behavior is really classified again, as I mentioned, related to a lot of factors. So very tough to generalize in a different market environment, for instance.
okay.
Human behavior and hence investor behavior could be very, very different. I think so long as you're clear about your principles and your objectives and you consistently apply them over cycles, that's perhaps an easy way or a simple way to define how you should be looking at preserving and growing your wealth.
Wow. So if I look at 2 points on this topic, you're basically saying it's consistency and preservation of wealth and then growing the wealth. I mean,
Yeah.
that's typically how you
And your objectives very clearly. That's the starting.
and okay, the starting objective. Where do you want yourself to be or your family to be X many years ago, or X many years from now on? Wow, awesome. Uh, Typically, we're talking large sums of money to be managed, right? Uh, the risk conversations can be very, very tricky in terms of, as you rightly said, the new set of investors are a little more aggressive than maybe the previous, maybe our generation. I don't know whether we form a part of Gen Z, Gen X, I don't know. But given that, आपके हिसाब से रिस्क रिटर्न वाला कॉन्वर्जेशन आज की जो क्लाइंट्स हैं प्राइवेट वेल्थ के, क्या वो वही कॉन्वर्जेशंस हैं जो पहले हुआ करते थे?
I would say so. I think those principles haven't changed, and neither are they expected to change. The environment's dynamic, the tools available keep evolving. The advent of tech also is a huge enabler, and I think it's really the thing that's going to redefine this industry over the next decade or so.
Okay.
If I step back, if you see this industry, it's probably a 20-year-old industry, 25-year-old industry in India.
Okay.
Before that, people were not really thinking about wealth management per se in a very meaningful or in a substantial fashion.
Okay.
I think the first decade of evolution of this industry was defined by just figuring out what needs to be done with wealth. And hence, it was oriented a lot through relationships. And
Okay.
that's how the industry evolved. And the next decade was more about product evolution and innovation as the investor base got more savvy, got more learned, and hence started distinguishing based on products available in the market and first to market, and customizing products to suit a market environment became the theme. But if you ask me going forward, if there's one single thing that's going to define this industry, that's going to be technology in terms of how this industry evolves over the next decade. Technology is not just making a difference on enablement or on analysis and reporting, but I think in terms of the aggregation of portfolios, in terms of what you could do and running countless sensitivities on that.
Mm-hmm.
Also, things like, high frequency trading, which is perhaps, or even medium frequency trading, which is perhaps at a very, very nascent stage in the industry. A lot of these aspects will get combed into how an investor looks at his wealth and how he looks at it in a wealth manager. And hence, the wealth management firms will also need to evolve and how quickly they adopt to this changing world of technology is going to be a differentiating factor.
Wonderful. Now, I pick up 2 points here out of this beautiful explanation, Anuj. One is you said products, you said technology we come to the technology part, and you also spoke about relationships. Now, here is the trick. How do you balance between the product and the relationship? So I'll just try elaborating the question by saying, if I'm a wealth manager with an X set of no relationships and I move from A to B, a different setup, are my clients likely to move along with me, or are my clients going to be more influenced by what's the product experience? How does the balance work for the client?
Yeah, very interesting question, very
Yeah.
topical, because this is related to hiring, which is perhaps one of the biggest banes
Yeah.
of this industry at this point of time. There's a lack of quality talent, and supply is getting outstripped by demand currently. But coming back to your question, I think relationship is a stagnant,
Okay.
and that's not going to go away
Okay.
at all. This industry is a lot about client stickiness because of trust with his wealth manager. And that's not going to change. Technology can't change that. Yes, your product innovation, yes, the advent of technology can improve a lot of things and enable the client to move from one to the other. But the biggest inertia to this is relationship, and that is what is at the fulcrum or the base of this industry, and that's not going to change.
Oh, that's good.
Technology cannot replace that human touch, especially as you move into the upper segments of the society. Uh, so that's inherent. That's a given.
Okay.
Secondly, product innovation is also a given.
Okay.
But to more specifically answer your question, I think the thumb rule is when we hire a person or when an industry person gets hired, not all relationships, not all assets will move.
True.
The thumb rule is not more than 35% of the asset base, 40% of the asset base will move eventually over a period of time, that too not in the first 6 months. And the regulator is also making it harder and harder in terms of movement of assets and how soon can the new platform start accruing income from those assets. So I would say that's the thumb rule, but eventually it's a function of how strong your relationship is and how strong the belief of your client is in the new platform that you're joining as well.
Okay. So hypothetically, if we compare two wealth management units, right, wealth management A and B, and if I were to move from A to B with my wealth manager moving, right, why would I want to choose relationship over returns?
You wouldn't. And which is why 70% of the assets will not move.
Okay.
If I'm happy and relationships get institutionalized also over a period of time, if my wealth manager moves, I will not necessarily move if I'm happy with the wealth manager, because I'll replace the relationship manager that I have. But in certain cases, if there is blind reliance or a very, very high level of reliance on the wealth manager, and in my mind as an investor, I hold him responsible for the returns that I've made, and I'm happy with the returns. And I'm more or less confident that he's moving to a reasonable platform, I will move.
Oh, so it's not something that it's a split second decision. It's a well thought out. It's like getting into a whole new universe of relationship if you move from A to B.
Absolutely.
Oh,
Yeah.
wonderful.
And there's a fair amount of documentation involved.
Oh, yeah. But I'm hoping with technology that you're talking about,
It's getting easier.
the onboarding process or the transfer process eventually will start getting a lot more seamless than what it is today. It's still
It is. There's digital onboarding, absolutely paperless on our platform, and it is getting easier. But the regulator sometimes makes it more cumbersome as well, for their due reasons as well.
yeah, absolutely. Uh, no, all of us are used to speed, right? Instant cafes, instant fastos, and stuff like that. All of us are so used to it. How does the wealth manager in you ensures that the investor is not kind of driven by the speed, and hence with speed comes aggression, and hence with aggression comes a higher reward expectation? So how does one cut the noise and keep speed for certain things, but not compromise on the quality of advice. And how do you handle?
So I think we all know that markets don't go one way.
True.
You don't make money endlessly in the markets, be it debt, equity, or any other asset class for that matter. Or doing short-term debt paper and flipping it more often than not, trading in the market and stuff. So there is something available for every investor mentality.
Okay.
So long as you understand the repercussions of that mentality
True.
very clearly.
Now here's the question, Anuj, that you start a relationship with a very clear dynamics about the risk and reward. For our investors, what I want to know is, can my risk perception change, and how does the risk mapping happen?
I think it's a very, to answer your second question first, it's a very, very elaborate process as far as risk mapping is concerned. And that's at the start of a new relationship. It's a very exhaustive questionnaire that we get clients to fill up or at least discuss verbally to try and understand. And also, now to answer your first question, risk perceptions from a client perspective
Or
ours
in appetite
changes
changes.
because we are living in such a volatile world.
Absolutely.
Today a COVID happens or a war happens or, interest rates change.
True.
Well, interest rates, currencies always move, but they move much more dynamically perhaps today than they used to. And hence, it's a very dynamic process of constantly evolving mindset of our investors
Okay.
and keeping pace with that evolving mindset to make sure that we are customizing our offerings based on their evolving mindset. It's not a static situation. Even for the lowest risk investor, it's not a static portfolio that you would run. So your advice to him or what you're discussing with him would always constantly evolve as well. Now, that does not mean that you're changing your views and your suggestions or offerings every now and then.
True.
You are consistent in behavior based on your initial risk profile. But having said that, given the dynamism of the environment and your own perspective evolving, you always could customize based on that evolution process.
Okay. That was quite enlightening for me. So the corollary to that question, Anuj, is, before I kind of move into a slightly more funnier stuff of rapid fire, is the corollary to that is, how do you handle the customer who feels having missed out? The FOMO feeling. Oh, all these private clients have probably the same club that they go to. They have the same affinity, probably the same concerts they attend, and then they obviously share what. And the guy who makes more probably talks a little more than the guy who makes less, because winners is what I know. The limelight is on the winners than the suboptimal returners, right? How do you handle a tricky conversation with the client where he says, you know what, my friend A made more money with the same time frame than I did? I mean, it can be very discomforting for you as a wealth person, right?
It is, it is. There's a very simple rule in life.
Okay.
There'll always be somebody
True.
smarter than you, wealthier than you.
True.
And if you keep looking,
And if it's your friend, it's worse.
exactly.
Okay.
More often than not, you will find it in a friend.
Absolutely.
So I think staying level and easier said than done, staying level headed, looking all around you, not just up or down, but all around you, having that 360 view is very, very important.
Okay.
So you be transparent in a relationship. One out of 20 startups perhaps succeed, but my friend invested in a startup and made 100x. And that's the story that gets tom-tommed.
Absolutely.
So being very, very transparent about all the failures, all the risks involved is paramount.
Okay.
And that's how you will inculcate a very, very strong relationship, a sticky relationship over from generations, not just years. And this industry is all about that. So we've seen recently another example is the unlisted market.
Yeah.
We've seen the amount of money people have made in unlisted stocks like NSE. And there was a fear of missing out and everything was just going up. And it's about the strength to say no. That's more important than joining the bandwagon and just doing everything that's available in the market as an investor or as a wealth manager. It's about where you need to say no. And that comes with experience, that comes with discipline, that comes with consistency in applying principles. That's paramount. Absolutely non-negotiable.
Wonderful. So finally, Anuj, how does JM Wealth look at managing wealth of clients in terms of how what would be the three things that you would actually attribute to why JM should be the go-to? Uh,
I think we are about longevity and consistency. So, this is a 50-year-old plus brand.
okay.
There's a reason why this brand has survived. If you look around yourself, some of the biggest brands in financial services are not 50-year-old.
Yeah.
And the reason for that is client trust.
Oh yeah.
We have not compromised on that. And that's the legacy that this institution stands for, that we want to carry forward.
So that's a big responsibility, actually.
Absolutely. It's a huge responsibility. And it's a lot of power as well, but with power comes a lot of responsibility.
Absolutely. Absolutely.
So because
Time out.
because of this trust, we have access to some of the topmost clients who want to bank with us, but we cannot compromise on this one bit. So at the heart of it is our belief that we will not compromise on client trust.
Okay.
And that's what we stand for. And even in the short run, if that means not growing as fast or that means some amount of negativity for our business, we are happy to absorb that because we are here for generations and not just for a few years and decades. So that's point number one, most important. I think secondly, we've done the 0 to 10 journey,
Okay.
well behind us, and we're growing across the country and globally uh, to bank Indians and some of the other local diaspora.
Cool.
We enjoy the benefits of being a successful financial services platform. And that one JM approach is what we are trying to blend seamlessly into our wealth journey for our clients. So we make sure that when we talk to our clients, we just don't talk about their wealth and the products that we have to offer. We start our discussion with their business,
Okay.
how the business is evolving, what their M&A requirements are, what kind of capital raising they're looking at,
Okay.
and then step into their wealth and how it links into their
Wow.
operating company,
Wow.
and then also think through legacy planning, their structures, and so on and so forth. So the comprehensive umbrella of plugging in the investment bank, our lending capabilities, our alternative asset management capabilities, our mutual fund, all of these, if you ask me, my ideal banker is somebody who can have this comprehensive conversation. Because then you'll end up getting mind share from clients like nobody's business. And that's what the client wants. He doesn't want to go to 10 people for his 10 requirements. He might as well have one fill up those 8 requirements and probably go to one or two other people, and that's it.
True.
So that's the second point, I think, where we are distinguishing ourselves quite emphatically. And I think third, I would say we're focusing a lot on hiring the right kind of talent, which is a big issue, as I mentioned earlier.
Yeah.
A lot on training and development, uh, making sure that the culture, the ethos of the organization does not get compromised.
Okay.
We have a great incentive structure. We have ESOPs for our people as well. So we are competitive on those fronts. I'm not saying we compromise on any of those fronts, but we're making sure that as we are growing very fast, a year back, we were probably present in 7 or 8 locations in India. Today, it's 22 cities. And we are penetrating deeper and further into the real Bharat, which is where a lot of the growth is coming from. So while we do all of this, we are making sure that we are well tuned to manage this growth and are not compromising on the talent because it's a people's business ultimately. If we compromise a little bit there,
It's not
when your delivery gets compromised with clients.
wonderful. Wonderful. Anuj, that was quite enlightening. So let's have some fun on this. You can answer this without giving an iota of thought, right? That's the rapid fire. So this is going to test the wealth genes in you. What's more dangerous, overconfidence or impatience?
Impatience.
Wow. Overconfidence is okay.
You can sometimes camouflage it.
Super. Loved it. Loved it. One investing habit you wish more Indians follow.
Patience, again, and consistency.
Okay. So you are consistent. So you said about patience and so you chose a bit. How often should I check my portfolios on a wealth client?
If you're in the right hands, you don't need to check it more than once a month.
Oh, more than once a month.
Yeah.
In the plethora of tech available.
Absolutely. Absolutely. But again, depends. If you're a trader mentality, you'll check it a few times a day.
Correct.
Or probably be online trading yourself.
True.
But for a client who's looking at beating, benchmarks and growing wealth, if you're in the right hands, you will just review with your wealth manager or managers not more than
Not once a month. Wow. And the last is, if you are not into wealth business, what would you be?
I don't know. I probably would be a financial reporter, or maybe even dabble with some secret services agency.
Wow.
Yeah.
I mean, you have the looks for both. And hopefully the appetite too.
Yeah. I think this is more the influence of media on me.
Oh, yeah. Thank you so much, Anuj. It was wonderful talking to you. Pleasure's on this episode. And I hope our audience finds this conversation a lot more enlightening as much as I did. And we hope to have you again on such conversations a lot more often. So thank you so much, Anuj. And that's it from us on Bold by BlinkX. Thank you and have a great weekend.
Investments in securities markets are subject to market risk. Read all the related documents carefully before investing.